It's hard to believe that another month has already come and gone. August, you were great to me. I had my 25th birthday, golfed a bunch, spent time with friends and family, but now with September rolling around, that means it's time for a new stock to watch video for the month. Now, I want to make this clear that this doesn't necessarily mean stocks to buy. Rather, these videos are intended to highlight some stocks that might have my attention for reasons such as recent earnings, news, and overall just that I believe might be worthy of adding to a watch list at the very least for a longer term investment, that is. In this light, these are not companies I'm looking at from a shorter term swing trade standpoint. Rather, these are companies I would only consider taking an investment in, right? Are these companies that I would be comfortable parking my money in for the next 3 to 5 years for reasons such as fundamental underlying growth and other reasons we'll be discussing in today's video. So let's get right into it. The first company we'll be looking at here is WELL Health Technologies, ticker symbol WELL on the Toronto Stock Exchange. And this is a stock that I actually hold both in my personal account and more recently took a smaller position in my public portfolio account. And with WELL having recently just reported their earnings for the quarter ending June 30th, 2021, what better time than to make an update on this company? Now, the stock itself has had some pretty choppy trading over the past year with significant levels of volatility above some resistance in the high $6 range following the major run-up that it experienced in the second half of 2020. In fact, considering that telehealth peers such as TDoc in the US have sold off more than 50% from all-time highs, WELL Health is faring quite nicely and from an underlying growth standpoint has been hitting top-line growth out of the park. Most recently though, Q2 figures were astronomical with record quarterly revenues of $61.8 million, representing growth of 484% year over year. This growth mainly resulted from a 432% increase in their virtual services revenue, which is exactly what we would want to see from a company such as this one. Gross profit also increased substantially by 615% year over year, with most recent gross margins hitting just shy of 50%. This happened to also be the company's third consecutive quarter of positive EBITDA at $11.9 million for the quarter. So even though WELL Health has continued burning through staggering amounts of cash and posting negative earnings figures, well, I'm still liking what I'm seeing in terms of the aggressive expansion strategy that they've been deploying, and this is leading to monumental top-line growth figures. And even though the company's current price to sales ratio does remain quite pricey in the big picture, it has dropped down by more than 50% to levels that we were seeing pre-run-up as a result of their top-line performance. So overall, I'm holding on to my shares of WELL Health Technologies. This is a company that I do believe will continue expanding quite rapidly, and for this reason will increase their financial performance over the next 5 years or so. And in parallel to this, it's also a company that's going to greatly benefit from the growth of the telehealth industry as a whole. This is something that I'm still very bullish on as we're seeing an aging population, growing population, and overall just a larger need for alternative medical care. Moving on to the second stock that I'm keeping my eye on for this month, and in reality, I keep my eye on this stock all the time. It is Granite REIT, ticker symbol GRT, and this is an industrial real estate investment trust. We've spoken about this company and their stock a few times on the channel now, and I personally hold it in my own portfolios as I really am bullish on the continued need and growth of industrial style properties. This is also backed by data that I've been able to gather from doing my own research, so things such as logistics centers as well as industrial warehouses. As a shareholder, this is a stock that does continue to impress me, not only from their consistent growth and appreciation in share price, but also from its nice dividend yield of 3.26%, all of which make it one of the more stable stocks in my portfolio, which is also nice to have in a portfolio that is more centered towards growth. And most recently, Granite REIT has posted their Q2 figures along with the news that they've acquired 3 new income properties and a development property in the United States at a combined purchase price of $198 million. Across the board in this quarter's finances, nice performance with the company's net operating income at $80.3 million, which represents growth of 12.8% year over year. Remember, this is a real estate investment trust, so we're not going to be seeing necessarily increases in net operating income or top line, such as what we're seeing in tech stocks, right? This is a company that is growing a lot slower, however, is more consistent in this growth. Their funds from operation, being a metric for the financial viability of an REIT, also exceeded my expectations at 62.2 million, up roughly 20% since Q2 2020. And by the way, I'd also like to mention the fact that since Granite is an industrial REIT, well, their finances were not really affected throughout the course of the pandemic. In fact, they have never missed any payments whatsoever in rental collection. They've collected 100% of their payments even since the beginning of the pandemic. So this is a fair comparison to make from 1 year prior. Now, in terms of their property portfolio, we're looking at fair market value appreciation that has absolutely skyrocketed over the past year, with appreciation of around $300 million in the second quarter alone. This is pretty much the exact same thing as your house appreciating in value over the past year. This is a company that owns a massive amount of real estate. So with real estate having boomed over the past year and a half, well, their properties have also increased in market value. And when it comes to an REIT, well, the increase in fair market value is actually reflected in the bottom line, so their net income. And that's the exact reason why, if we take a look at this company's net income, it actually exceeds their top line, which of course is not necessarily the case. This is more of a paper increase in asset value. And that's also why back in early 2020, a lot of these REITs were posting massive losses. It was more of a paper loss than anything else. And now we're seeing the opposite happen. With that said, while GRT's fair market value for their assets has now exceeded $6.4 billion, they've also managed to reduce their overall debt levels. Finally, Granite has a long history of leasing out a quite large portion of their overall leasable area to Magna International, which is a car parts manufacturer. And so with an REIT, well, if you have a large portion of your entire revenue coming from one single tenant, this could somewhat be problematic if that tenant ends up getting into any type of fiscal distress where they're not able to make their payments. But Granite REIT has actually been focusing quite a bit on reducing quarter over quarter the percentage of their total annual rents from this one single tenant. In fact, we can see right here that even quarter over quarter, they have reduced this relative value once again, where in the last quarter, it has dropped to 34% of annualized revenue, down from 36%. So overall, Granite REIT is trading at all-time highs. That is something to definitely be aware of. However, this continues to be one of my favorite Canadian dividend stocks, along with favorite REITs to invest in, both for that consistent appreciation, but then also for a nice dividend yield. Moving on to stock number 3, I just could not leave this one out of today's video because it has been hit so hard lately. It's Corsair, ticker CRSR. And honestly, I did not expect the stock to reach the $25 range. I was absolutely shocked to see this, but it changes absolutely nothing from my outlook on the further growth of this company's stock. Corsair was recently caught up in a Wall Street bets rally and has since sold off quite a bit, but I'm holding on and have been even bolstering my position below the $30 range more recently, as I believe this represents a complete bargain for this company's stock right now. And over the past month, the company did release their earnings for the quarter ending June 30th, 2021, which did show some slower than expected growth, which did also contribute to the toppling share price. But despite the slower than expected growth, we're still looking at $473 million in top line for this quarter, which year over year represents an increase of 25%. And considering that last year in Q2, there was a significant increase in demand resulting from the pandemic. So 25% growth is actually great to see. We should also keep in mind that this is a type of company that does experience cyclical sales, where Q3 and Q4 are always going to be their best quarters as it's gearing up for the holiday season. What is a bit more concerning for Corsair though is supply chain issues resulting from things such as semiconductors being unavailable right now, along with just overall rising costs, all of which are digging a bit into this company's gross profit margins. Nonetheless, the company has actually been focusing on paying down their outstanding debt by an additional $25 million this past quarter, and in the past year alone, Corsair has reduced their overall debts by 45%, which is quite impressive actually. Overall, this past quarter was actually quite decent for Corsair, and I believe that the negative price action that we've been seeing is unwarranted. This is a growing company that's increasing their financials in all the right places. They've also been launching many new products in the first half of the year, all aimed at gaming and streaming, which are massively growing industries. In fact, ARK Investments is projecting substantial increases in video game consumption over the next 5 years, with projected 21% compounded compounded annual growth. Of course, Corsair isn't really a company making video games themselves, however, they will benefit. So again, I've actually been bolstering my position in Corsair under the $30 mark. I think this is an absolute steal, and being bearish on a stock simply due to negative price action makes absolutely no sense. Let's now talk about the fourth stock, which is Facebook, and this is a company I actually haven't spoken about in a little while, but for those who've been riding the wave since I mentioned it in the $280 range, you've seen some pretty hefty gains. Facebook stock, ticker symbol FB, really needs no introduction. They're the world-leading social media platform, owning other companies such as Instagram as well as WhatsApp, and they now have over 3.5 billion active users across their platforms, a year-over-year increase of 12%. Just think of that for a second though, 3.5 billion monthly active users across their platforms. That's nearly half of the entire world's population, and this is going to continue growing as more individuals gain access to the internet. Now, the stock is trading basically at all-time highs right now, so again, that is something to definitely be aware of. However, considering their underlying levels of financial growth, the relative PE ratio is right in line with what it's been since 2017. In fact, we can see that their earnings per share have been really taking off since early 2020. The same thing applies to their price to sales and price to free cash flow figures, nothing out of the ordinary since 2017 and even before. This past quarter was also fantastic at total revenues of 29 billion, having increased by a whopping 56%, and their income from operations has more than doubled. In fact, their operating margin has also increased by over 10 points, and net income has more than doubled. Facebook truly is a digital advertising powerhouse that very little can stop at this point, considering their massive amount of momentum. Now, interestingly, Facebook's CFO is stating that they're projecting year-over-year total revenue growth rates to actually decelerate in the second half of 2021, which I'm quite surprised by because usually Q3 and Q4 are the best quarters for a company such as this one that relies on digital advertising revenue. But this rationale is because we're starting to lap periods of increasing growth resulting from the pandemic. Nonetheless, this simply means a deceleration in terms of the relative percentage growth that we're going to be seeing. Facebook will continue seeing larger increasing numbers. It's just that from a relative basis, they're expecting a deceleration. Facebook's financial position though is always stellar. Currently, they have a current ratio of 5.43 with over $64 billion in cash and cash equivalents. And finally, Mark Zuckerberg has recently been speaking about a sort of metaverse that they're looking to create, and I'm extremely excited about this. Can't wait to see what that's going to be all about. Kind of gives me Ready Player One vibes, to be honest. So yeah, we'll see how that plays out, but could be an extremely interesting monetization platform moving forward for Facebook. All right, moving into the last stock. This is somewhat of a bonus, and we won't really get into it since I recently spoke about Amazon, but I just wanted to mention the fact that after their Q2 figures, we saw a massive sell-off in their share price, but this was considering massive underlying growth and pretty much the lowest PE that we've seen for this company in over a decade. I am so bullish on Amazon. It's one of my largest positions as an individual stock, that is, and really look at what we're seeing right now on their stock chart. So since then, it has bounced back significantly. This is exactly what I had called for. So hopefully you have Amazon on your watch list, and hopefully even more in your portfolio. That is, over the next 10 years, this is a stock that I do not plan on selling pretty much ever. One of the best companies in the world, and it is absolutely guaranteed that this stock will continue crushing growth figures over the next decade. All right, that wraps up today's video going over an update on these different stocks for the month of September. Make sure to drop a like if you enjoyed today's video and comment down below what your thoughts are on each one of these companies. If you want to learn more about stock market investing, make sure to subscribe to the channel, hit the bell button, and check out all of the other content already posted on the channel. With that said, if you'd like to get some free money, check out the links down below to resources I use and recommend where you can get some free money for opening up brokerage accounts and other accounts of that nature. So with all that said, thanks a lot for watching today's video. I will see you in the next one.